great start to the week. Russell moving, NASDAQ with it. Kevin Green joining us to talk some options flow and some of the market structure dynamics to look at this week. KG, we are off to the races. Let's first kind of talk about some things that have started to normalize. We were talking a lot about the chart earlier. We've totally recouped the August loss. Have we seen some of the liquidity and some of the stuff we've been monitoring come back into the market in a more normal way?
Yeah, definitely. We have seen liquidity coming back into the market. If we actually utilize the E-mini S&P futures, the depth of market basically from the CME, you can actually see that we're pretty much back at levels that we saw back in July 24th. Now, around that time, we did have a little bit of a pullback in the market, which is why we actually saw that drawdown to the downside here. But traditionally, we were sitting around these levels, around 45 contracts on the bid, 45 contracts on the ask for the E-mini S&P 500 futures. If you want to see that get up to around 65 contracts, that would be full, bull type of market here. But this just kind of shows that you don't always have to just look at the technicals. You can also add in some of these other factors that are out there to be able to see where the market could be positioning. And right now, the spreads are looking really healthy, really small spreads that are out there, very large book depth that's out there right now. So the market can actually absorb these downside moves or even the upside moves for that in that nature here. And so we'll kind of talk about this moving forward, but you could have actually a little bit more of a squeeze type of scenario here taking place, where you have dealers actually buying more futures contracts, and that buying activity will then also strengthen that book depth even more, potentially going into the close here.
Great stuff. All right, so strength begets kind of more strength and stability. I love that chart as it kind of shows how we really got pinched in there. That's a fun way to look at it. So, all right, since the pool is clean and deep again, let's go into where the major players are splashing around. Take us through the open interest, looking at the chart first here.
Yeah, so the open interest, the gamma level to the upside here, positive gamma level sitting at 5,600. We're pretty much there right now, Oliver, right? So even if you're looking at the volume side or even at the open interest side, 5,600 is going to be your key area of resistance here in the near term. Now, that's a potential that could actually happen. What's happened over the last couple of weeks is this rolling up and out of calls here for a lot of those institutions that are utilizing those calls in order to collar their portfolios. We continue to see that activity. One thing to just note, though, the roll activity today for the 5650s, which is higher than the current market value right now, it's not as aggressive as what we saw last week. Now, that doesn't mean that the market's not going to be able to attain that level. You just would like to continue to see that aggressiveness of rolling to the upside, really trying to widen out these bands. The intermediate area, 5,500, we saw that last week going into the close. That continues to be an area of near-term support for the market. And then negative gamma is sitting at 5,400. Now, you kind of want to see that negative gamma level start to move up a little bit. You want to see a lot of these institutions moving up their hedges on the put side. It doesn't mean that that has to be bearish, but that does mean that we could actually tighten up the market here. If we have those puts kind of getting higher and higher when it comes to the strike value, once you get kind of close to that level, you could see dealers coming in, buying futures to try to get us to avoid that level. You don't really want to see it really trailing too much behind, because then that leaves this massive gap to the downside here where we're hitting the upper end of that range. So from a technical standpoint, over the next couple of days, you'd like to see those 5,400s maybe moving up to 5,450 or even to the 5,000 level. And once again, that wouldn't be bearish right now. If we continue to see this price action, that would actually be healthy and provide us some stability at those levels if we were to see any type of meaningful pullback over the next couple of trading sessions.
Okay, so one thing here that seems to stand out to me is the soft calls that are getting rolled at 5,650. Does that mean that this big call wall at 5,600 becomes a little bit less threatening? Is that kind of the nature of it?
Yeah, I mean, and that's what we've been seeing all of last week too. So yes, you're starting to see those rolls from the 5,600 up to the 5,650s. But when I say that soft roll, I just mean that it's not as aggressive as what we saw last week, where you just saw massive blocks moving up on an incremental basis. It's just not as much flow. So actually, it's probably a little bit more of a wall at the 5,600 level than what we've seen over the last week. At the 5,550s or even the 5,500 level, this one's a little bit more aggressive, a little bit more sticky for now. And that could actually change on a day-by-day basis. But for now, it does appear that we still have some movement to the upside. We can get there. It's just not as aggressive. And once again, on the put side, we're not seeing any type of real meaningful flows to move up those hedges of the downside here, which is why we also see a very low VIX. Just to note too, Oliver, we do have VIX expiration they officially expire on Wednesday, but tomorrow you'll see a lot of VIX options activity taking place. And actually today we're seeing that as well. Be mindful of that. That readjustment of those VIX positions could also create some volatility in the near term. Doesn't mean it has to be negative, just noting that we might see a little bit of vol going into VIX expiration on Wednesday morning.
Okay, cool. Good heads up. To follow up on the 5650, the last point is, compared to last week, has the open interest, is it today bigger than it was last week? So they continue to add on to those positions. So it's just the rate of change is not as dramatic as last week?
Exactly, and we'll get the final open interest numbers tonight after the close, or tomorrow morning after the close. So we'll be able to match that up. But if you're kind of looking just at the opening volume and matching the closing volume that we can see right now, it doesn't seem like it's that aggressive. But once again, there's still meaningful size there. I mean, the market is overall bullish. Let's not get it twisted, but it's just not as aggressive as what we saw, where we just had massive blocks of $2.5 million, maybe even $3 million worth of premium being taken in, rolled up, and rolled out. Today, it's more about, $1.25 million, $2 million blocks. Not as aggressive once again. Okay,
but still net positive flow into that strike. Okay, gotcha. All right, cool.
Correct.
All right, so then if we kind of look at the volumes on the chart, looking at levels again to kind of give us the perspective for this close and then this week, I mean, it seems like we're kind of like at a pretty, magnetic area here, or what do we got?
Yeah, so Oliver, I would say today it would be one of those days where we could see a pretty decent squeeze to the upside if the price action allows. Now, we are seeing some pressure here at the 55.90 level. This has actually been an area that saw a lot of call selling activity early in the morning, and then a lot of buying activity about maybe 30 minutes, 45 minutes after that. And so it's a magnet for today at 55.90. You could have some pen risk there. The reason why I say we could have actually a pretty decent squeeze today if the price is going to allow it is the fact that we have around $70 billion of estimated dealer exposure at the 55.90 level. And Oliver, that's probably one of the higher ones that we've seen since we started doing this segment. And what that also just traditionally means is if we can actually break through 56.05 today, that's when we are going to have a significant amount of buyers stepping in on those S&P 500 futures in order for those dealers to be able to hedge their risk to the upside here. This melt up type of scenario. Now they're going to try to dampen it down as much as they possibly can, because that's a lot of risk. I mean, last week we were looking at these gamma levels that had 6 billion, maybe 7 billion worth of exposure. You're talking 10x that right now. So this is where we could have a wall, but if we can break that wall, it could be a pretty dramatic move to the upside. Now, downside risk here, 55.60, that's going to be our negative gamma area, but I'm going to be honest with you, it's very low size there. So there's not a lot of bearish activity taking place. We did see some flows going into the 55.60s around 10 minutes ago, Oliver, but all of that was put selling, not put buying. So put selling is actually ultimately bullish for this market. We have a balance level at 55.72. That's where dealers would be net neutral on the day. Overall, going into the close, this is actually bullish. It would be fun to see a break between above 56.05 and see what that squeeze could actually provide us here. I'm not saying that's going to happen. It just would be an environment where it would create a massive melt up scenario. 55.90, your pin risk, meaning the market could close at that level just because there's just that huge wall or that concentration of call buyers and call sellers at that area is very large on a relative basis over the last couple of weeks.
Okay, all right, nice, cool. So we're not too far away. If we can just get a nice little push, kind of try and squeeze some of those positions into expiration this week. All right, so it's a good start, about as good as we could ask for, hanging out, at important levels or above them. Thanks, Kevin Green.